A major shift is underway in global business, one that's quietly but profoundly reshaping the world's economic landscape. Japanese companies, once deeply invested in the U.S., are now closing American factories and moving their operations to China, marking a dramatic change in international business strategy. We're not talking about small players. Think Toyota and Sony, household names that have long been symbols of Japanese innovation and reliability. For decades, seeing "Made in USA" on a Japanese product was more than a label. It was a sign of a powerful alliance, a blending of American labor and Japanese technology that benefited both nations. Now, that label is fading, replaced by a new reality centered in China, where the majority of manufacturing is rapidly shifting. This move is sending shockwaves through the global economy, raising concerns among investors, workers, and policymakers alike. The U.S. was once the top destination for Japanese firms to build and sell products, a land of opportunity and growth for decades. American workers built millions of Japanese cars and electronics, creating jobs, supporting families, and strengthening economic ties between the two countries. But the ground is shifting beneath their feet, and the familiar landscape of American industry is changing fast. The reasons are complex: new taxes, rising labor and operational costs, and a business climate that's becoming less predictable and more challenging for foreign investors. The result? A steady exodus that's forcing both Washington and Tokyo to ask, why now? And what does this mean for the future of their economic partnership? Headlines tell the story. Panasonic closing plants, Nissan scaling back U.S. operations, and more companies quietly following suit. These aren't isolated decisions. They're part of a coordinated pivot, a strategic withdrawal that's gaining momentum. Japanese executives are rethinking their strategies, weighing the risks and rewards, and closely watching global politics and their bottom lines. Their new path leads straight to China, which is actively welcoming foreign investment with open arms, incentives, and promises of growth. The implications are massive, not just for American workers who face uncertainty and job losses, but for global trade, supply chains, and international alliances. This is a strategic realignment, a deliberate migration of capital, technology, and expertise from the U.S. to China, reshaping the future of manufacturing. Japanese companies aren't just chasing lower wages, they're seeking greater efficiency, advanced infrastructure, and access to a massive, rapidly growing consumer market. China offers a more predictable business environment, government support, and a new center of gravity in the global economy that's hard to ignore. This corporate migration is a powerful signal, a wake-up call for industries and governments around the world. For some of the world's most important companies, the risks of staying in the U.S. now outweigh the rewards, prompting tough decisions and new beginnings. And China is ready to welcome them with open arms, eager to cement its role as the new hub of global manufacturing. The world is watching as this new chapter unfolds, with every headline and every factory closure signaling a deeper transformation. The question is, what comes next for American industry? Can it adapt, or will it be left behind in this new era of global competition? For over 50 years, the U.S. Japan economic partnership was a model for the world. It was a relationship built on mutual trust, shared prosperity, and a vision of global leadership that shaped the post-war era. Japanese brands like Honda and Sony became household names in America, not just as imports, but as local manufacturers. Their logos became symbols of quality and innovation, woven into the fabric of American daily life. They built massive factories in states like Ohio and Tennessee, creating thousands of jobs and revitalizing entire communities that had been struggling with industrial decline. This deep integration was celebrated as a win-win, a rare example of globalization that seemed to benefit everyone involved. Producing in America let Japanese companies avoid import taxes and be closer to their biggest customers, while also supporting local suppliers and economies. The presence of a Toyota or Nissan factory could transform an entire region, bringing new infrastructure, schools, and hope for the future. This connection once seemed unbreakable, a partnership that would last for generations. But now, the unthinkable is happening. The landscape is shifting in ways few could have predicted. Japanese companies are dismantling parts of their U.S. manufacturing base, a historic reversal that signals deeper changes beneath the surface. It signals a loss of faith in the American market as a stable, profitable place to produce. Uncertainty about the future is growing. This isn't a decision taken lightly. It means writing off billions in investments and severing long-term relationships that took decades to build. The shift to China is more than a change in location. It's a change in mindset, a strategic pivot toward new opportunities, and away from old certainties. Japanese leaders now see the future of growth and stability in the East, not the West. China's booming market and rapid innovation are drawing them in. This breakup is quiet, happening through a series of calculated corporate moves, boardroom decisions, and confidential negotiations. Behind the polite statements about restructuring lies a stark reality: the end of an era and the beginning of a new, uncertain chapter. The trust that underpinned the U.S. Japan business relationship is eroding, replaced by caution and strategic distance. Companies that once saw their future tied to America are hedging their bets, diversifying investments, and seeking new alliances. China is emerging as the primary beneficiary of this shift, welcoming Japanese expertise and capital with open arms. The era of unquestioned American economic leadership is being challenged, and the consequences will ripple across industries and borders. Japanese industry is voting with its feet, and the world is watching as a new balance of power takes shape. What's driving this dramatic move? Why are so many companies, especially Japanese firms, rethinking their strategies and shifting their operations? It comes down to three key factors: tariffs, rising costs, and the transformation of global supply chains. First, tariffs. Recent U.S. trade policy has created a climate of uncertainty for international companies, making it harder to plan for the future. Even Japanese firms that manufacture in the U.S. still depend on imported parts, and these are now subject to new tariffs and fees. These extra costs squeeze already thin profit margins, making U.S. production less attractive and less competitive on the global stage. Second, the rising cost of doing business in America. Labor costs are climbing steadily. Skilled workers are increasingly difficult to find, and new regulations add layers of overhead and complexity. Healthcare expenses and compliance costs further erode profits, forcing companies to rethink their long-term investments. For companies like Panasonic, every extra dollar spent in the U.S. is a dollar lost, money that could be invested elsewhere for better returns. The American dream, once a beacon for global corporations, is becoming increasingly expensive and difficult to sustain. Third, global supply chains are being completely rewritten in real time. The old model was about making parts in the cheapest locations and assembling them elsewhere, chasing the lowest costs. Now, it's about resilience, integration, and minimizing risk. Companies want supply chains that can withstand shocks and disruptions. China isn't just a source of cheap labor anymore, it's become a hub for sophisticated, highly integrated supply networks that offer speed and flexibility. Almost every component, from the smallest screw to the most advanced microchip, can now be sourced locally in China. This creates incredible efficiency and reliability. For Toyota and other manufacturers, sourcing nearly all parts locally in China slashes costs, reduces delays, and eliminates many logistics headaches. The triple threat of tariffs, rising costs, and China's unmatched efficiency is creating a perfect storm for U.S. manufacturing. The old model of building in America to sell to Americans is breaking down under the weight of these pressures. The risk and expense of U.S. manufacturing have reached a tipping point, forcing companies to make tough decisions. Japanese companies are following the path of least resistance and greatest opportunity by shifting their focus to China. For many, that path now leads directly to China, the new center of global manufacturing and supply. This shift isn't just theory, it's happening right now, in real time, across multiple industries. In the auto industry, Toyota, Honda, and Nissan are deepening investments in China while simultaneously rethinking their U.S. presence. Toyota recently expanded electric vehicle production in partnership with leading Chinese firms, aiming for greater efficiency. It's not just about serving China, it's about tapping into the world's best and most advanced EV battery supply chain. Building in China lets Toyota make electric cars more cheaply and efficiently than in the US, giving them a competitive edge. Honda and Nissan are following suit, strengthening alliances with Chinese partners for both local and global markets. Some functions from R&D to parts procurement are shifting from North America to China, reflecting a major transformation. The message is clear. The future of auto manufacturing is shifting east, and it's happening fast. The electronics sector is following the same trend, moving operations to China for strategic reasons. Sony is moving production of cameras and electronics from US-linked facilities to China, seeking new opportunities. China's electronics ecosystem, especially in cities like Shenzhen, is unmatched anywhere else in the world. This allows Sony to innovate faster, cut costs, and get products to market quicker than ever before. Panasonic is scaling back US operations and boosting investments in Chinese factories to stay competitive. They're building new plants in China for batteries and key electronic components, expanding their footprint. For Panasonic, it's about being at the center of the world's largest and fastest growing market for electronics and EVs. Producing in China means lower costs, faster logistics, and proximity to major customers and suppliers. It's a strategic decision to be where the action is and where the future is being built. The world's biggest Japanese brands are making their bets, and they're betting on China's continued rise. The global business map is being redrawn before our eyes, and the center of gravity is shifting eastward.